Hi, and welcome back to It Depends, a sales tax podcast by TaxConnex, focused on simplifying the complexity of sales and use tax. I'm your host, Brian Greer, and today, June 21st, we have a very special episode for you. It's officially been 5 years since the Supreme Court decision reshaped the world of sales tax forever. That's right, the South Dakota versus Wayfair case came to a close on June 21st of 2018. Prior to this case, the prevailing standard for sales tax collection was based solely on having a physical presence in a state. In 2018, the Supreme Court took up the case of South Dakota versus Wayfair, with South Dakota arguing that the physical presence standard was no longer appropriate in the digital age. In their decision, the Supreme Court ruled in favor of South Dakota, enabling states to require retailers to collect and remit sales tax even if they have no physical presence within the state. The historic case has had far-reaching implications for a significant number of companies throughout the U.S. as well as the world. In turn, it's presented major challenges for these businesses as they try to navigate a complex web of sales tax laws and compliance requirements across many jurisdictions. This brings us to our topic today, the risks of non-compliance. Because of the Wayfair case, it's far more challenging for businesses to manage their sales tax obligations correctly and stay in compliance. So join us today as we cover the repercussions of non-compliance, how it's identified, responsible party laws, common errors, remediation tactics, and more. Welcome back to It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. Before we get too far down the path here, I'm going to give you guys just kind of a quick overview of TaxConnex. If you're not familiar with us, we do focus exclusively in this sales and use tax industry. There's really two different types of services that we offer. One is a consulting or advisory type of service. Most of what we're talking about today would likely fit into that category in terms of helping companies identify where they have nexus, where they have taxable sales, maybe initiating some voluntary disclosures, for example. But then the second service offering that we have is a compliance outsourcing service, where we essentially become an outsourced sales tax department for businesses and prepare and file returns and just kind of manage that ongoing sales tax process for them. So that's the TaxConnex commercial for the day. Just covering the agenda here very briefly, but we'll talk about, really some of these issues associated with not being in compliance. How are those issues identified? What leads to non-compliance issues? We'll talk a little bit about how to quantify some of that risk and exposure. You see a piece here just talking about common errors that we frequently see with businesses. But we also wanted to leave everybody with at least some type of potential action step or next step, so we can talk about, what are some of those options for remediating risk if you find that you're in a spot of non-compliance. So Jeff, I'll go ahead and turn this over to you for the first piece. And like most things sales tax, I think we start with a nexus discussion.
Yeah. I think it's always important to reset the foundation for sales and use taxes, and that foundation, as Brian said, is really establishing where nexus exists. So in the sales tax sort of compliance responsibility, without nexus, there is no responsibility, is the easiest way to say it. Nexus is simply a connection with a state or jurisdiction that affords that jurisdiction the authority to impose its taxing obligations on the company. So we always start there, and we wanted to do just a quick overview of that, talk a little bit about it. Historically, and as we talk about risk of sales tax non-compliance and just understanding where you should be compliant, where you don't need to be compliant, Historically, we've thought about this from a physical presence perspective, meaning I had to have an office, I had to have inventory, I had to have employees located in the state before I was establishing nexus, before I had any obligation to comply with sales tax rules. Well, as most of you are probably aware, about 3.5 years ago, the Supreme Court afforded states the opportunity to enact economic nexus standards, meaning the physical presence was no longer the strict adherence that the states had to follow for asserting nexus. They now could open up the nexus footprint to companies that just had revenue in their states. Now, the majority of the states and all the states at this point have enacted some level of an economic nexus standard. The majority of the states basically set a bright line test, $100,000 in a 12-month period or calendar year in gross receipts. And in a lot of those states, they also said you could also establish nexus by merely having 200 or more transactions in the state. Now, like everything with sales and use tax, there's always variables, nuances, differences between states. And we're not going to go into any more depth on nexus, but suffice it to say that not all the states are $100,000. Texas is a $500,000 threshold, for example. Not all of the states have 200 transactions. You know, some of the states define gross receipts as just that, gross receipts, while other states will impose their nexus standard at a retail receipts level. So there's just a number of things to consider, but I think laying a foundation of keep your eyes open in your business for circumstances where you've exceeded $100,000 in revenue, and you should be materially in good shape for at least pulling back the covers and identifying whether truly nexus exists in that state, or if you're okay to keep moving forward and doing business. Once you've established nexus, the next question becomes whether or not you make taxable sales of products or services. An example, I can use TaxConnex as an example. We clearly have nexus here in Georgia. That's where we're headquartered, and that's where we're speaking to you from today. But we don't provide a service or products that are subject to sales tax in Georgia. And as such, we're excluded from taxation, and we don't have a registration or compliance requirement. So it's not enough just to have nexus. Nexus is just a piece, and a very important piece of the equation. But then you've got to venture down the path of evaluating your products and services. And really what's important to note here is if you're accustomed to doing business in 1 or 2 or 3 states, and you've sort of got the rules down for those specific states, it's very easy to have the perspective that those same rules apply throughout all the states. And that's just not the case. The general rule of thumb, similar to that economic nexus standard, thinking about it at $100,000, the general rule of thumb on the sales taxability scenario is if you are selling tangible personal property, you should assume it's taxable, unless the customer has some form of an exemption. So it's sort of the baseline for all of the general statutes out there for those states that have a sales tax, that it starts with sales of tangible personal property. You know, at the end of the day, if you have nexus, you need to be asking questions about what your business activities include in that particular state. It's not always the case that because you have nexus and taxability in one state, that just because you have nexus in another state, you may not have taxable transactions. But it's just a good starting point and a good foundational piece to the equation. The thing that I used to tell my clients, or I've always told my clients, is, look, to the extent that you're not paying attention to nexus, you're not paying attention to sales tax at all, the starting point is assume 10% of your gross revenue is taxable. Assume that you have the responsibility to charge tax on 10% of your revenues and collect that tax as an agent on the behalf of the state and remit it to the state. And failure to act upon that obligation puts the onus and liability squarely on the seller's back. And so it's a target you just don't want to have. So I think, again, starting from the nexus as a foundational aspect of determining your sales and use tax compliance responsibilities, before you even start down that path and you decide, hey, how much time do I even want to spend on sales tax? Is it relevant to me? Well, it's probably relevant to some extent somewhere. Just about every possible service scenario, if you're particularly selling in an interstate fashion, is going to find that it's taxable in at least a couple of states. That's just the way it is. The other thing that I think people get caught off guard by is when they go down a path of trying to get funding, private equity funding, venture capital funding, whatever the case may be, there's usually some level of due diligence that's performed. And it's not uncommon for that due diligence to include a sales and use tax analysis. They're going to look at the nexus footprint, and they're going to evaluate at a fairly high level the taxability of the products and services. So it can have quite an impact on an ability to get some funding or direct funding into the business. And similarly, the same thing is going to happen with a merger or an acquisition, except that it's more likely under these circumstances that due diligence will uncover any potential exposure risk. They're going to come in, identify where nexus exists, and if there's sales tax due in those specific locations, that amount of tax is going to get escrowed. And in most cases, there's the buyer has the authority or at least the power to require the seller to go down some mitigation paths to mitigate that exposure and liability. It's usually not a very favorable circumstance or outcome for the seller. And so you don't necessarily want to go into an M&A scenario with zero risk or zero exposure. That's not the message we'd have for you today. But you should know what you know. In other words, have an idea as to what your potential risk and exposure is so that you're at least not surprised by it or caught off guard. You can speak to it. And it's not uncommon for companies to take business cases and evaluate the cost associated with the compliance and compare that to the risk of non-compliance and make a business decision not to comply. That's not an uncommon practice. So that's okay. It's just that you want to have that knowledge and that storyline when you go down that path. The last piece of this is it's kind of like a little bit of a fright thing. There are circumstances where people have gone down a path of trying to be compliant. They've registered, they've started a collection process, and for whatever reason, staff turnover, business changes, they all of a sudden just lose sight of this sort of ongoing process of tax collection and forget to file. There's going to be actions that the states are going to take to alert you to this fairly quickly. But if you're grossly negligent and you've collected a bunch of tax and you've never remitted it, and particularly if that tax went into your GL and was moved into a revenue account, there's the potential you could be subject to a criminal charge. And that criminal charge is asserted against corporate officers of the business. So that's worst case scenario. My background, I've been in sales tax for 32 years. Never have I had a client find themselves in that specific predicament, the last one, the criminal offense predicament. I have had clients that have been surprised and exposed during due diligence quite often, frankly. The other thing I would say is in my 32 years, I started as an auditor with the North Carolina Department of Revenue, and in that capacity, we did pursue criminal offenses against a number of folks, and I've been directly involved with a few of those. So it's not a fun place to be. Usually those people are very intentional about those activities. They know what they're doing. They're defrauding the government. They're taking advantage of those circumstances. The government is not looking to try to create cases against people that are making mistakes. So that's not something to worry too much about.
Yeah, at some point, Jeff, we'll we'll need you to share some of those fun stories from the past. I've heard a few of them.
So as you think about those scenarios I just described, going down a path of a M&A and due diligence, the question a lot of folks have is, well, how does my exposure get identified? How does risk in the world of sales tax get identified if you're not in a position where an M&A activity is occurring and due diligence is occurring? Well, there's a host of scenarios that can apply. This first bullet, nexus questionnaires, is something that's becoming more and more effective for the states. And since the passing of the Wayfair decision in 2018, the Supreme Court allowing states to enact economic nexus, that bright line test makes it a little bit easier for states to identify companies with nexus. It's just some basic, simple questions. How much revenue did you generate from customers in our state over the last 12 months? So there's more and more of that starting to become visible to us. We're seeing more of those types of notifications or documents being sent to customers. And historically, nexus questionnaires are not a new phenomena. They existed over the last 20 years in a lot of states. And if you go back 10, 12, 15 years ago, we customarily would tell folks to just ignore them. There's just no way to ignore them anymore. The states are more and more sophisticated. They've got technology that's sort of driving these processes. They're not going to forget about you. So if you don't respond, it's going to just take a next step, a next level. Eventually, it'll get to a place where they'll start sending out arbitrary assessments. So you just can't avoid it. Other ways that states identify companies as far as exposure to sales and use tax, business-to-business transactions are always being audited by the Departments of Revenue. So whether it's your business being audited or one of your customers' businesses being audited, or maybe one of your vendors' businesses being audited, there's 3 different opportunities there for the state to see transactions between you and a partner, business partner. Those can lead to questions, observations, assumptions, which then can lead to audits and exposure risk and assessments. When you look at sort of the way the jurisdictions are structured in their administrative policies, certainly there are times when they find it necessary to target a specific industry. So you just might get swept up in a cloud of industry sort of questions that are floating around, and they see there's just a host of issues that need to be cleared up, so they audit a broad spectrum of those folks in that industry. Certainly, if you've been audited historically by a state and there was significant risk and exposure, a big assessment, you're likely going to be tagged for a future audit within the cycle. So after 3-4 years, whatever the statute of limitations is, you're going to find yourself there. Then there's companies that are just so big. I don't know if any of us on this call would qualify, but there are companies that are so big, just like federal IRS audits, there are state auditors conducting audits all the time. And the audits take so much time. Sometimes there's a new audit started during the finalization of the prior audit. Don't discount the ability of a disgruntled customer or employee to create headaches for you. I had a very well-known, prominent retailer that everybody on this call, I'm sure, would recognize the name of. They have operations in every state in the U.S. and internationally, and they were selling fertilizer, and they were not taxing it appropriately. They were overcharging tax in a specific location or jurisdiction. And a customer just wanted to make things difficult for them. And I think the issue was like 65 cents in tax to the customer. But they started calling and reporting this taxpayer to the state and just creating a lot of headaches, calling customer service. It got important enough for them to engage me. I was at KPMG at the time, but it got important enough to engage me to try to help them to mitigate and smooth the issue out. So things happen, and they're not always predictable. And that's the random scenario. Brian wanted me to tell stories. I'll tell a quick one here that as I was an auditor with the North Carolina Department of Revenue, this is a long, long time ago, early 90s, and things just weren't very sophisticated back then. And we took liberties to do just about whatever we wanted because there was no real controls and visibility. And I remember driving down the street after lunch with my audit manager, and he said, "Have you ever heard of a 20-minute audit?" I said, "No." He just put his turn signal on, pulled into the next driveway. We walked in, we showed our credentials and said, you're under audit for sales tax purposes. Give us access to your records. We went through, thumbed through their records. Wasn't anything really there to worry about. And so we walked away. No assessment was issued. That's about as random as you get. And that doesn't happen anymore. I mean, the states are a lot more professional now, but you just never know. And so I get asked quite often, what is my risk? You know, I'll do a nexus analysis for somebody. I'll give them some taxability advice. And they'll in turn ask, well, what are the worst states? What are the states that are most risk for us? What are the states that are most aggressive? And that's not an easy question to answer. I can tell you that the most populous states have the more sophisticated sales tax audit programs. So your Texas, California, Florida, New York, those states are pretty active in audits. But it's hard to say. You know, we have clients that'll go 15, 20 years having never been audited, never had an issue, thought they were bulletproof, and all of a sudden, in one particular case, it was Mississippi that knocked on the door. And what was interesting was that at the end of it, they engaged us to mitigate the audit. We got it to a no assessment audit, but it scared the pants off them. I don't know if that's the right term, but it scared them such that they instituted and implemented a full compliance program because they realized when they peeled the covers back and looked at their business activities, they had nexus everywhere. They had material sales, and they knew and understood that as they wanted to grow the business to eventually liquidate the business or have an equity event, I should call it, they were going to be at risk if they didn't get their arms around it. So, and we talked about due diligence as well as another area that's pretty commonplace for folks. You know, every state, when you go down a path of getting into compliance and registering, every state's going to ask for at least one corporate officer's name, a responsible party, and they want their Social Security number. And they're not going to let you get registered without that minimum level of data. And what they're really trying to manage and mitigate is someone registering for sales tax, going out, charging tax to customers, collecting that tax, and for cash flow reasons, they reappropriate those funds to cover payroll or to cover inventory expenses and ultimately file zero due returns, never remit that tax. Well, that officer ultimately could shut down the business a year later, go out of business. The legal entity itself doesn't exist. The FEIN doesn't exist anymore. And so what is the state to do when they uncover this fraud? They can go back to that individual and hold them personally accountable and their assets personally accountable. So it's not an easy task to avoid sales tax responsibilities. This can be as egregious as I just described, charging tax and not remitting it, but it can also evolve to simply operating in the state, having nexus, having taxable sales, and having a responsibility to charge and collect the tax, but you never did it. And it's possible a state could come back. There wouldn't be criminal charges in these scenarios usually, but they could hold you financially responsible as a corporate officer for not being in compliance, even though the legal entity may have dissolved. You know, misunderstanding nexus is very common. It's understandably complicated. Everybody's trying to run a business, and sales tax is not at the forefront of our strategy when we're trying to grow a business. But you know, we've experienced and seen things that to us, we live in sales and use tax daily. And so we think of things more clearly and obviously. Brian and I actually were at a meeting down in Texas with a business owner who had customers all over the country, very, very substantial business activities. And we were talking about Nexus, and he explained that he didn't have Nexus outside of the state of Texas. And as he described the business further, it turned out that in his business service offering, he engaged local subcontractors to perform installations of his product at hotels throughout the country. And of course, to Brian and I, that immediately smelt of Nexus for sales tax purposes. And indeed, it was a massive exposure. And it was shocking. He didn't realize that level of engagement of a third-party resource could potentially create Nexus. I mentioned earlier the rogue employee. I gave you the example of the volatile customer. I've got another one with regards to a CFO of a significant company that had been receiving these Nexus questionnaires I described earlier, and he was responding to them, stating that they did not have Nexus, but he was falsifying the information on the documents. So he was leading the states to believe their activities didn't rise to the level of Nexus. Well, ultimately, they found out this person was embezzling money from the company. And when they went to enforce or prosecute them, this person went out and called all of these states that he had falsified these documents with and told them that the company was, in fact, non-compliant and was doing business and had sales tax responsibilities in each of these states. So after about the fourth call, within about a 2-week span from a state saying they wanted to initiate an audit, they got the sense there was a problem. And they were forced to engage in mitigation efforts in 34 states as a result of that one employee operating the way they were. It's extremely expensive. The cash impacts of these situations, when they come out of left field and they're not expected, can have a devastating effect on a business. Taxability determination is another area that certainly is complicated, and I don't think anyone's expected as a business manager to understand the taxability of all their products and services in every state. And as a result, there are technologies that help to fulfill that need. But there are still a lot of companies that they don't have a broad spectrum of products and services, and they feel pretty comfortable that they can determine the taxability on their own. And one of the more common areas that people mess up is professional services. That's a term that a lot of people use. It really is a term of art. It's not a legal term from a statutory perspective in sales and use taxes, but the states do go to some degree to define what professional services are. And a lot of times things that involve intellectual advice, the stuff that TaxConnex does, it kind of falls into the category of professional services. A doctor, a lawyer, an architect, an engineer, those services are fairly represented in that term, professional services. However, if you get into the technology business, there's a whole host of professional services that are provided in addition to the sale or the licensing or subscriptions of software. And it's commonplace to put them into that category of professional services. And the reality is, in a lot of states, those activities, they might be configuration of software. They could be support services, training services, implementation or installation services. Those are characterized by most in the industry as professional services. However, they are commonly taxable in a lot of states. So it's just a slippery slope. It's complicated, and as a result, you typically are going to be in a position where you either need to do your own research, engage a third party, or subscribe to some third-party software application to help you with that. Citing complexities, these are very common in today's marketplace. drop shipments particularly. Everybody has a business now that's online, but nobody's maintaining inventory. They're taking orders through a website. They're engaging a distributor to ship the product to the customer. And there's a lot of times this sort of dynamic of three states that are involved. You've got the retailer located in state 1, the customer in state 2, and the distributor in state 3. And it gets fairly complicated when that retailer attempts to issue a resale exemption certificate to the distributor in an effort to avoid paying tax on their purchase. And there's a question as to whether they have an obligation to charge tax to the end user or the customer in that other state. This is a difficult area for a lot of companies to manage. It's difficult for both the retailers and the distributors. Customers, not so much. They don't necessarily care. But it's a complicated area because there are some very specific and special rules that exist for drop shipments in a lot of states. So there's both opportunity in this example, and there's also anxiety. The other piece that's usually creating some level of anxiety for companies is software as a service. As you know, the subscription model affords a company to subscribe and the users to be based just virtually anywhere. So you could have employees throughout the country accessing this software, and depending on where they're located and where they're receiving the benefit of that access drives the tax treatment. Well, the vendor doesn't necessarily know that there are employees in all of these different states. They may have engaged and contracted with the company at headquarters, and as such, they're only applying tax to that headquarters location. It's a complicated area. There are some opportunities or options to manage around that. Not all options apply to the same way to every company. So it is, but it's just something to alert you to the fact that it's something you want to maybe research and get some support on. Lack of exemption certificates, those are it's a fairly obvious and a fairly common scenario. If you're selling to a lot of nonprofits, and this particular scenario I'm going to describe involved a merger and acquisition. It was actually an acquisition of a software company that a big portion of their business was selling to nonprofits. And in doing so, they made the assumption that those nonprofits were exempt from tax. And in a lot of cases they are, but there is still a requirement to receive a certificate, an affidavit usually signed by the customer, that basically proves that they are in fact a nonprofit and exempt from sales tax. And this particular company had not made that effort to gather those documents. So as they went into this acquisition, due diligence uncovered this fact, and they were exposed, and there was a significant escrow. They were able to go back and recover some of the exemption certificates, but not all of them. And it was an expensive endeavor, both the effort and the escrow that was a pretty material hit to them. And the last error that we see companies make, and this isn't so much an error, it's just a lack of experience and understanding. And I'm not suggesting that everybody needs to get help every time a sales tax audit starts, so don't misunderstand this. But you do want to have a little bit of a sense for how audits are going to go when you're audited and what to provide and not provide to the auditors. You need to understand the exposure or the risks that exist in the business so that you can manage around that. We had a client that was audited by the state of New York, and what they were really providing was essentially a non-taxable service to some extent. And their invoices themselves were fine. They provided a level or a degree of certainty that they were not a taxable event. However, attached and stapled to each of those invoices was a work order. And in that work order, there was a description. In a lot of cases, it described a person physically going to the location of the customer and doing something in the way of repair, maintenance, or improvement to technology. And the invoice itself was around managed services in a remote capacity. But because that work order had that description that involved that on-site activity, that changed the complexion of that transaction, made it taxable. They received a $780,000 assessment as a result of that issue. Big cash flow impact. On the flip side, it's not uncommon to find yourself under audit by somebody that's absolutely clueless. I, having been a former auditor, can say that, I feel. And you get all kinds of auditors, good, bad, and ugly. We had a client that was being audited by the state of Michigan, and the auditor essentially had no idea. We purposely made it confusing when we described the business and how it worked and how it operated, because we knew the client was exposed. They were definitely at risk. But in doing our performance of the audit management, we confused the auditor to a degree that they totally missed all of this risk and all this exposure. They were so confused that as they were writing up the audit, the final audit, he emailed me and asked me if I could write the summary of the audit for him. It could be presented to their manager. And our client was never assessed. It was a very odd experience, very unfortunate for the state, but beneficial to our client. If you are in a situation where you've charged and collected tax, you need to be intent on remitting that tax, reporting and remitting that tax to the government, or refunding it to your customer. You would be better suited if in that scenario, let's say it was a valid tax charge and it should have been charged on the invoice, but you haven't registered and don't plan to register with the state, you'd be better positioned to just refund that tax back to the customer and live with that risk. The state could still come and audit you and assess you, but at that point, the tax is out of your hands. So we never want to be in that position where we've got tax that's been charged, collected, and sits on our books without being intended to be remitted to the state. I purposely emphasized and used the word intended because it's not uncommon for businesses as they're growing to start down a path of trying to be compliant, and then all of a sudden they start selling into a new state, an immaterial amount, and so their systems just automatically start to collect the tax. Just make sure you've got visibility into that, and within a reasonable period of time, get registered sooner than later so that you can get that tax reported. So you find yourself having been exposed, whether you've charged the tax or not, and during an analysis, you decide, hey, I got a problem here. One of the solutions is just to simply get registered and remit the tax and then comply prospectively. That doesn't mean you've mitigated all of your exposure, but it does at least mitigate the tax portion. And then the state, if they want to come in and audit you later and say you should have paid the tax earlier, they'll assess you some penalties and interest. You're probably going to get relief from some of that penalty. The other side of the equation is you haven't charged the tax, but you know you had nexus for a period of time. You know that you should have been charging tax. You don't have the cash and the wherewithal to satisfy those liabilities. You'd have to go back to the customer, and that's really not an option for most of us either. And so you might just accrue for that risk, meaning let's get something on the financials that says, hey, we're aware that we probably have some risk, but we're accrued for it, and then to the event, or in the event you're audited, you at least have an accrual to hit for that assessment. Exemptions and not XYZ letters, haven't got your exemptions in order, you still have an opportunity to do that. Don't feel as though you can't go back and recover by getting an exemption certificate after the fact. It's somewhat problematic. You'll have some debates with the auditors, but more often than not, they're going to accept those. XYZ letter may not be something you're familiar with. It's kind of a term of art in the sales and use tax world. It's nothing more than an affidavit that's executed by a buyer of products and services who wasn't charged tax on the initial invoice, but accrued the tax and remitted it directly to the state, or perhaps they were audited and assessed tax on those products and services. So the tax has already been assessed and paid directly to the state. The XYZ letter serves to prove that and provides the seller with evidence that they can then hand off to either an acquirer who's doing due diligence or hand off to a state that's performing an audit to satisfy that potential exposure. Voluntary disclosure agreements is a category that most of our clients find themselves in under two circumstances. One, they've been charging and collecting tax, but they failed to remit it and it's a material amount. Or two, they've entered into an acquisition agreement, due diligence has been performed, and the buyer wants no part of that prior period exposure, and they're forcing the company to do the voluntary disclosure. A voluntary disclosure is something that exists virtually in every state. It does have different flavors depending on the state you're going with. So they don't all look exactly alike, but essentially what they involve and afford is an ability, if you have not charged and collected the tax, you have the ability to enter into this voluntary disclosure agreement where the state will give you the benefit of a limited look-back period. It's usually a 3 to 4 year statute of limitations look-back period. And in exchange for that, you're going to disclose all of that liability during that last 3 to 4 years. The state will waive the penalties automatically, and they will impose interest usually. So the value of voluntary disclosure agreement in most scenarios that we work with is where I've been doing business for 5, 7, 8 years. And in those 5th, 6th, 7th, and 8th years back, I've got material exposure. I didn't charge tax. And if I'm audited, the state's going to assess me on those. Whereas if I go down the VDA or the voluntary disclosure agreement path, I can get the state to forgive those older periods and only assess me on the more recent periods. Now, again, this doesn't work if you've collected the tax. There is no limit on the look back under a voluntary disclosure, but it's a very commonly used process for us to get clients to a place where they no longer have exposure and risk in the prior periods.
Thank you, everyone, for joining us, and look forward to catching up again soon. Bye-bye.
Thank you.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.